Welcome to the Tom Matt Show. You are walking through the front door of the retirement zone. And now, your host, Tom Matt.
Hey everybody, welcome to this week's episode of the Tom Matt Show. Thank you, Sandy, so much for doing the lead-ins for radio. For you guys on the podcast that catch this thing, so sorry, Charlie, you don't get to hear that kind of stuff because that's on radio. But if you wanted to, you could just get the podcast strictly on YouTube, and it's just completely no video whatsoever. Last week, I mean, when Robert Bryce comes in here, and getting him for the show was really just kind of amazing because there's so much going on. We talked about Spain drain and energy. Robert Bryce, you know, is the kingpin from Austin, Texas. If you don't know that name, look him up. He's one of the most well-known energy experts in the country. And that is not a fabrication or outlandish comment by me. He is unbelievable. And it was really, really fun show to talk about. But the big takeaway from this, and we'll get to today's episode, talking about the marketing of renewable energy, that's what you want to pay attention to. That's all I'm going to say. All right. Just pay attention to the marketing of the renewable energy cult. Mm-hmm. I'm sorry for you people that are in the cult. We can pull you out. Maybe with my guest today, Craig Stiles, financial crisis. Okay. Craig, you know the drill here, with the family and all that good stuff that's going on and all the stuff you got. But first, I need to pick your brain and say, how many episodes have you been on this radio program? What's today's?
28.
30. Ding, 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 ding. Pretty close, though. I thought he knows. He knows how it's there's a lot. So anyways, you guys, go to our financial fitness on the website, and Craig's there. There's so much information there on investing, all that good stuff. Hey, how are you, man? Sorry for the long intro. I had Robert Bryce last week, and he was just, I'm telling you what, man, that guy lit it up. And what do you think about the cult of the alternative energy, whatever that is? What do you think about that?
You know, I'm always, as you know, in a lot of our conversations that I've had with, especially when it comes to investing, because a lot of times alternative investments, alternative energy comes up when it's a topic of an investment discipline or whatnot. And then being that new technology to include cryptocurrencies, to include staples such as commodities of gold and silver, there's pros and cons to every dynamic. And you could classify the interest that people may have in any one of these types of alternative investments or commodities as somewhat of a cult, so to speak. But what you're addressing is more on the marketing component. And that's why even on the investment side, when I hear clients talking or having concerns about the markets, the more that I hear gold being marketed, buy gold, buy this, or you hear investment firms talk about guarantees, guaranteed income, whatever it might be, you know that they want you to buy their products, charge a commission, whatever the structure might be. They want to have you for a long period of time, which you have deferred sales charges, or you can only buy a product through a particular organization, and then they will sell it back to you one way or the other, or buy it back from you and get a commission on the front and back end. And then I sit there and think, well, the opportunity then is they must have a strong feeling about the markets going forward, because the only way they would be able to make money is either having a commission from you by selling in mass quantities in some form, or they buy you and you're locked into a particular product for 5, 6, 7, 10, 15 years. And they expect that the markets are going to outperform over that time period, which is to the advantage of the client. If they didn't get into something, keep in mind, every product there is a specific purpose. But if somebody gets oversold a particular product or feels like they're sold a product, that's when it becomes more of an issue, I think, in many areas, which kind of drives the cult part, the marketing piece, that it can make a product look dangerous, for lack of a better term.
All right. And I want to clarify. Thank you, Craig, for that. That was a nice long way you segued from alternative energy marketing into financial, but it's
how
true.
It applies into it, right?
How it applies into it. But you know what? I want to clarify something right now. I don't want anybody going, Tom, you called me, I'm a member of the cult. No, hold on. What Craig said, it's a marketing is cult-like. Okay. Yep. The marketing of alt energy is cult-like. I am absolutely down with having many sources of energy.
Yep.
That's why we have Robert Bryce on, because we got a problem in our country with energy and the growth of, if we want to continue to grow this country and our economy, we must have a strong, robust network, and people just don't get it. It's like, listen, and these things take a long time to build and all the permits and all that. So anyways, that leads into the financial craziness. But before we go there,
even not even to digress, but even when you sit there and think of the resources, the different levels of resources in different areas. Now, just like you said, having multiple energy sources is an important component. Having the tornadoes that went through my hometown, my area, that kind of affected us. We had a neighbor that had a big solar panel, but the dynamic that was keeping people alive and running in their homes, for lack of, when I say alive, but going and minimal, I hear a lot of generators that were fired and running that were running off of propane or gasoline that had minimal disruption, while that was helping to the families, individuals get back into a normal life, clean up everything. Where our neighbor that had the solar panels, it was destroyed. It's still not fixed. Their large solar panel, which they would run throughout the day, it's still damaged. The infrastructure to repair facilities such as that, or things like, is not there. So we're now back up and running. We've got our power, we've got our energy back up. To have that switch and that change, everybody wants to have that level, but to market it, we always have to be cautious on what is being sold, because when you're marketing something, you're trying to sell something.
That's right. All right. So now that we've talked and used up all of the family time almost, let's do 2 minutes of family time. Catch everybody up. I mean, Visit 30. Everybody knows your family's grown up on this show, but yes. Give us a quick lowdown on that. We got about 2.5 minutes before we got to go to break.
Well, as you know, my oldest is getting married next month, so we've got that going on. My son Christian started a nice job working as a technician for and working on MRI equipment, and X-ray equipment. So that's kind of a nice thing that he's involved in. My son Charlie's got another year left. He'll be finishing up in mechanical engineering. My daughter Miriam, serial entrepreneur in a wide variety of ways, helping out on farms, horse breeding, harvesting honey, working with a guide on taking photographs of hunting and fishing and
love it.
The whole dynamic. And that's Miriam. My son Peyton's graduating high school this year, so we have the graduation party coming up also a couple weeks before the wedding. And he's getting into automotive mechanics, so he's already a certified mechanic in a couple of different areas. So and then my son Zachariah, and then the kids are in high school. We just got done with homeschooling performing arts in April. So from that perspective, what the kids were involved in with that, it's all fun and games. And then of course the soccer season's picked up. So I've got Peyton's in soccer, my twins are in soccer, my daughter Chaley's in soccer. So then my daughter Maggie, can't forget Maggie. Maggie's in soccer and just as talented in a wide variety of ways. So yeah, we got a lot of things going on right now, for sure.
And there's one name you forgot to mention. Don't be a bonehead.
What's that?
Don't be a bonehead, man. There's one name you forgot.
Josephine, baby JoJo.
No, not okay. Then there was two. Okay, double bonehead.
So I'm like, who did I forget?
Double bonehead. My buddy here. My buddy, the double bonehead. You better say your wife's name.
Oh yes. Well, you asked about the kids. And children,
I said family, brah.
Absolutely. Where it all began.
Good job on the synopsis of the family in about 2 minutes here. Let me reset this bad boy because we're going to go to break here. And we haven't talked any financial craziness yet, but we will, believe me. There's some other things. We're going to talk about some stuff. There's decompression that's going to happen here. But I got another idea too that I want to ask Craig, because he brought this up about kids and entrepreneurship. And since we talk financial fitness, getting kids to work, it's certainly a topic that we need to discuss. Mm-hmm. An article that I read today in the Wall Street Journal about kids in high school, juniors in high school, getting recruited like college athletes, giving them $70,000 offers at juniors in high school to go into these skilled trades programs. Love it so much. We'll talk about that when we come back. This is the Tom Matt Show. Craig Stiles is here. Financial craziness. We'll be right back.
This segment of the Tom Matt Show is brought to you in part by the Source of Light and Power by band leader Archibald and broadcaster Mitch Anderson. Hear the sound that is endorsed by Odyssey headphones, linear tube audio, RME converters, and Peluso microphones at sourceoflightandpower.bandcamp.com.
Welcome to the Tom Matt Show.
Welcome back. Welcome back, everybody. Thank you so much for joining us. Thank you, Sandy, for bringing us in on radio. Segment sponsored by Ameriprise Financial and Craig, our guest today, Craig Stiles. Financial Fitness, 30 episodes. This is his 30th episode today. Been with us forever. And, full disclosure, I've said this, I don't even know, hundreds of times. All of our retirement zone savings, I told another guy, 80-year-old guy in the gym today about retirement. He was just loving it. I mean, retirement is a decision. The guy was kind of talking himself down a little bit. And I said, dude, you're 80 some years old and you're getting ready to go swim a mile. Are you kidding me? That's what Craig can do for you. He can help you get to the life you want, like he's doing for us. With the right financial advisor, life can be brilliant. And I like that line a lot. Life can be brilliant. Call Craig, 1-800-528-1355. I can't tell you how many people from Michigan State University have turned down to Craig. And other people outside the university too. Just because. I mean, come on. 517-483-4893. I should know that number. I've said it so many times. Craig, email craig.stiles@ampf.com. His offices are located at 2651 Coolidge Road, Suite 103, East Lansing, Michigan, 48823. Don't let the East Lansing, Michigan address mess you up or anything, everybody, or dissuade you from getting a hold of Craig, because he can vet. They're a huge company. Ameriprise is giant, and he can vet everything for you. So, I mean, point of contact is not going to cost you anything. Stations that have carried us, do carry us, have carried us, WGHN 92.1 FM in Grand Haven. First to ever carry us on broadcast radio many years ago. So proud to say their name. Thank you to Will Team and Wendy Hart. WGIM 1240 AM is the flagship of the Michigan Talk Network, where we are broadcast and syndicated all over the Midwest. WJRW 1340 AM in Grand Rapids. WKLQ 1490 Muskegon Whitehall. WIPV FM 94.5 Mackinac City. And last but not least, my 80-year-old buddy at the gym, my new buddy says, is your show on WKAR? I said, well, you know what? It happens to be on WKAR at 5 o'clock on Sundays at AM 870 and simulcast at 102.3 FM. Thanks again to Craig Stiles for sponsoring this segment. Decideri Analytics was his creation, where he made this lineup. We are making light of weighted decisions. Weighted decisions with financial fitness. Let's talk about it. And again, thank you to Steve and Ivy Gruber for carrying us on the Michigan Talk Network all these years. They're the bomb. All right, back to Craig. Financial craziness. We haven't even started talking about financial craziness yet, but we will. One thing I've written down from some of our notes, and I got a couple of things. You mentioned some tech and some other things. First, let's take this first, because this show is going to air, second quarter of this year, 2025. Mm-hmm. Give everybody a synopsis, Craig. You can take the rest of the segment if you want. And talk about what has occurred since Trump was elected, since was it January 20th or whatever when he was sworn in. And then we had all that. Go ahead. You got the recap. Do it.
Well, you can basically, we had a kind of, once after the elections, we had a pullback in December, right? The markets had pulled back. And then, of course, you had a rebound in January, and literally to the day of roughly about the 19th of February, so the markets had a level of correction or turning around within the markets. And again, when you talk about marketing pieces, there's a lot of marketing that was going on trying to build a specific narrative. What is the response? Understanding that we've had growth within the markets over the last couple of years. And typically when you have growth within the markets, you're going to have a level of correction that takes place. As we've talked before on the show, when in a 12-month period, you could expect a correction of 10% or greater within a 12-month period. That happens typically at least once every 12 months. And then also 3 times in a 12-month period, you're going to see a correction that takes place, or a pullback in the markets of 5% that occur 3 times in a 12-month period. That's just a natural market cycle, to where you'll have buildup, profit taking that takes place, and then build up, profit taking that takes place. A lot of institutional investors, that's what they do, and then trying to time that, especially if you have a lot of passive investing that takes place, people buying in and getting out of exchange traded funds or index type funds or strategies. And that's where actively managed portfolios tend to shine a little bit more in areas of volatility.
Before you go farther, hold on a sec, Craig. Sorry, I don't mean to interrupt you. When you say actively managed, can you explain that, what that means? Because that's part of what you do.
Yeah, like if you have, just use this as an example, if you have a mutual fund, that you can buy mutual funds, which they themselves are their own individual companies, right? So you can buy a mutual fund that mirrors the S&P 500, where that portfolio manager for a mutual fund of the S&P 500 will buy the stocks, have the similar asset allocation as what you'd have within the S&P 500, the index. And they would just match what's in the index. So it's kind of passively managed to where they're not actively adjusting or changing asset allocations or buying or selling individual stocks. They're just taking a photo, basically a photo of what's there and managing or adjusting accordingly. To where an actively managed portfolio would be someone that you're hiring to either reduce risk within your portfolio relative to an index, enhance performance in some form or another, increase dividends that you might need within your income stream within your portfolio. Someone that you're hiring to actively manage your portfolio to buy and sell individual stocks that you want to own or have a specific need or purpose for. So typically passive used to be like buying an index fund, but now it's more like exchange traded funds or ETFs. So it becomes more efficient. Typically passive strategies, you are more focused on cost because in that round, that's where you get your advantages by reducing your fee structure. And so looking at those types of ETFs, you're buying, holding, and then want it for a longer period of time. But typically there's pros and cons to either one of those situations. So
okay, so there you go, everybody. That in a nutshell, to me, that means this explains sort of why you want to have somebody like Craig or his team actively managing my stuff, because I don't want to do it. That's bottom line is I don't want to do it. I don't know how to do it. I mean, I could go play Gambler Tom and lose all of our savings that we've worked 40 years for, or find somebody like a Craig Stiles who go back to the show on the fiduciary thing, everybody. Yep. We talked about exclusively a whole episode on fiduciary and what it meant. I'm not trying to be, I'm kind of clueless on a lot of this stuff, but so I like to explain things and get the experts in here, subject matter experts like a Craig. All right, Craig. So you said, and we got a minute to go here, so you can jump back in here if you'd like, but just quick question. Do you know, okay, on the 3 times on the 5% shift annually, and then 1 time at the 10% shift, how often does that occur? Is that a projection that's been over time?
Typically within a 12-month period.
Okay, but I mean, over time, is that a kind of a regular statistic?
Yeah, it's a pretty regular statistic.
Okay.
You can go through and take a look at the oscillations that take place within the markets. So historically, you can actually see those graphs, and that's quite frankly where they get it from has been historical references.
Right,
so
right.
All of those numbers that we pretty much talk about has been a pretty consistent staple.
And we'll talk about all the things that are going on with the tariffs and the deficit, because that adds into the financial craziness. But the point I'm trying to make here, everybody, I'm going to carry this through, Craig, because the break's coming. That's normal, okay? 10%, a one-time 10%, we may have another 10%. But you know what? We may have another 10% bounce up.
Yep.
As I have told Craig, and I have told Brock, and I've told my friends, I personally believe that by the end of this year, the market will be at 50,000. That's what I'm saying. I'm sticking by my guns. You guys can barbecue me later if you want. This is the Tom Matt Show.
Thank you again to our Segment 2 sponsor, Craig Stiles of Ameriprise Financial. For more information on services provided by Craig, please visit ameripriseadvisors.com/Craig.Stiles or by calling 517-483-4893. You're tuned in to the Tom Matt Show.
Welcome to the Tom Matt Show.
If you guys ever watch the in-between segments of our episodes of our radio program on YouTube, you should check them out, because there's a lot of behind-the-scenes stuff that goes on that's pretty comical. And so just to give you a little bit of an incentive, go check out our YouTube on the big full episodes, because you got the full episode, you got the full episode audio only, and then you got the excerpt. So you got 3 different ways you can check this out. All right. My sponsor for this segment is my other great friend, super guy. I talked to him yesterday. Brock Fletcher, selling team of Keller Williams Realty. Guy is crushing it. I mean, crushing it. He's starting new business groups. He's got all kinds of good things going on. He is working his butt off. Brock Fletcher, just like Craig, these guys are so hard working. They're so dedicated to helping you I don't know why in the heck you wouldn't want to use their services. We have, as I said, financial fitness, Craig Stiles, Ameriprise, Retirement Zone Savings. Boom. It's all there. It's doing fine. Our homes with Brock and Mikey Deadman. Mikey, you're going to come on a radio show here pretty soon. You don't even know that yet. We sold Big House Holt. We bought Little House Lansing. I mean, help Mike sell his house next door. I mean, it's just crazy how things work. You need to get a hold of Brock. Call Brock, 517-853-6408. This is the number, though. I'm going to say it twice. 517-303-3262. 517-303-3262. That is Brock's cell. Text him, leave him a voicemail. He will call you back. He's really good about changing his message every day. He'll leave a message on his voicemail that says, I will be returning calls at between 3 and 5 today. And he will. And because he's a pro. That's why you want to lose, because these guys are the guys you can trust. Go with them. Sell your home without the hassles. With the market being up and down, and I'm talking about the real estate market, with supply and demand. Brock said yesterday when I talked to him, there's some pretty good deals out there. Better than other parts of the country, let me tell you, because there's people all over the country that are getting crushed right now. All right, back to our financial craziness with Craig. All right, brother, we're hitting some good stuff here. We just talked about the bumps in the market that traditionally happen all the time. And one time 10%, 3 times 5%, shifts down. Yep. Check that out. I want to talk about the tariffs and the deficit spending and the deficit itself. We're in this weird space, Craig. Go ahead.
Yep. Which kind of ties into, I mean, that's what sparked that conversation about what naturally happened and occurs and what's being implemented or impacted by policy and adjustments. And then, of course, is it Trump's policies or is it something that was building up under the previous administration? And then it's just kind of letting go or unwinding with anticipation of what we anticipate going forward for the next couple of years. And how long is that going to look? What are business owners concerned about, both small, medium, and large businesses, because all of them deal with trade in some form or another. They all, you have some that have already been domestic, that have seen a lot of their business contract, that are looking to expand. I know of several businesses right now that are in the steel business, the rubber business, or tire business, that had lost contracts, large contracts, to foreign companies that have now, a lot of those distributors have come back to them already to where they were running one shift, and now they're back up and running 3 shifts. So you see that ability or that strength coming back within the manufacturing area, which you saw at one point in time, our manufacturing was 25% of our population was involved in manufacturing. That shrank to 10% over the last 30 to 40 years. You've seen the shrinking of our middle class over that last 30 to 40 years as well. And you saw the increase of the lower class and increase of the elite class. So you have that adjustments and changes, and then we have a huge policy change that we don't know exactly what that is going to be like over these next couple of years. We don't know exactly what that's going to look like, to be quite frank. And then having the ability to adjust, to be able to take a look what sectors of the markets are going to benefit and which ones are maybe impacted more negatively. Getting in, getting out. It is not an easy thing or an easy environment to be in when you're especially investing into the markets, which, because of that, is why you had a huge pullback after quote unquote Liberation Day, the 2nd of April. You know, the markets were already having a level of correction that were looking to go down to a 10% draw, because like I mentioned earlier in the previous segment, you can almost peg it to the day of the 19th of February, and through the rest of February, the markets were down. Through the entire month of March was negative. And then we're having somewhat of a rebound. And then all of a sudden on Wednesday, the markets really pulled back significantly over the next 4 or 5 days, where you saw the markets dropping 5, 6, 7%. And the next day, another 5, 6, 7%, to where we're approaching bear market territory from the beginning of the year. Now, a lot of that, because early in May now, a lot of that has already come back. So April was a very tough month over that time period, to where you don't want to necessarily get out and then get out at the bottom, because one day the markets were up double digits in one day. And so it recouped significantly over that time period. And so that is where understanding the investment discipline that you find yourself in You've got to be and want to be prepared for those down markets and have confidence in the strategy that you've implemented 6 months prior, a year prior, 5 years prior, and not make adjustments based on emotion. Because when you do that, that's when the most damage occurs for the longevity of your portfolios.
You can't jump in and out. That's the bottom line, is what Craig's talking about.
Right.
I want to
Right.
add something here, because Craig brought up the topic of manufacturing coming back. Okay. The thing about manufacturing, and for somebody my age, I remember in mid-Michigan when the auto factories were rolling, all of our friends, families, they all worked in manufacturing. Okay. We've talked a lot about manufacturing going away. The thing about now, everybody, and things that are coming back, what the administration and President Trump's doing, bringing manufacturing back. Manufacturing has changed tremendously. We have robots, we have AI, we have technologies that we need to have constantly. We have to have the supplies. The supply chain has to be here. So we're not making the cars like we used to. We're building chips. We're building data centers. We have power infrastructure that's going on. So manufacturing is massive. This leads me into what I wanted to talk to Craig about. We're not going to have enough time in this segment to do this, but I'm going to set up the topic Craig can talk about for a second. Kids in skilled trades. I read an article, and I told Craig about this today, where kids, I mentioned earlier, juniors in high school are getting offers, juniors who are in skilled trades classes are getting offers to start their employment when they graduate from high school at $70,000 and $80,000 a year. This guy was a welder, okay? So keep this in mind. Craig explained when we talked about the family for a couple seconds, all of his children, pretty much, most of them, are entrepreneurs. We need to have work ethic in this country. And to be in manufacturing is not a bad thing. And
Nope.
Craig, just give me a minute on that, what I just said about the high schools, the kids getting recruited right out of high school like college athletes.
Well, just like, I mean, my wife and I have this conversation, right? I have a college degree. My wife has a college degree. I went on and got a master's degree. I'm the only sibling in my family that's gone on to get some advanced degrees along those lines. And then that was our initial drive for our own kids. Our oldest have degrees in college. My third oldest is getting a degree. Miriam doesn't have a desire to go on to college. And it's like, we can't really justify for her to do that because she's built out a network and she's been a hard worker and already has a network of places that's going to provide for her family someday. The same thing for my son, Peyton, is has a desire for automotive. He has an opportunity right now with, he's collecting stacks of business cards of automotive companies that are looking to hire him, where he did a job shadow, finds out that some of the technicians at a local dealership where he's working or where has a potential or opportunity, some of the technicians are making north of 200 to 300.
Yeah, that's what I'm talking about, everybody.
So how long have they been there? I don't know, but the dynamic of being able to make that large of a commitment, it's awesome there, right? So it's the skill set there.
Large bank. And the other component of all this, everybody, is not having debt. Our young people having debt so that they can invest their money, buy homes, continue to build our economy. Because if our young people can't buy their own home, we're going to be in trouble.
Yep.
We got to fix this stuff. Craig Stiles is here. Financial craziness. This is the Tom Mann Show.
Thank you again to Brock Fletcher, real estate agent at the selling team with Keller Williams Realty. For more information on services provided by Brock, please call his personal cell phone at 517-303-3262 or by emailing Brock at kwsellingteam.com. This is the Tom Mann Show.
Welcome to the Tom Mann Show.
Thank you, Sandy, for bringing us back. And he just came up to the studio and said, bye. And I said, okay, bye, honey. See ya. Craig Stiles is here. Financial craziness. All right, before we get back into it, because, as usual, we're digressing all over the place, but that's typical for this radio program. So, and that's why people like it, because we like to be
All over the place.
a little bit wild. Craig, how do you want people to get a hold of you? And
The easiest thing is to type my name and basically Google or search my name and then at Ameriprise, and you'll come up with my website. And there's actually a way to coordinate a meeting or schedule a meeting for you on my website. So I'll get immediately contacted and then can coordinate meetings that way as well. So that's usually the easiest. The other is you can call my office directly, 517-483-4893. Again, it's 517-483-4893. That's my direct line. Leave a message with a number and or email address, and I can follow back up with you, and we can coordinate a time to sit down and talk about what you're looking to do, what you're needing to do as it relates to your overall personal finance or business finance or endowments or foundations, whatever the structure might be.
It takes time. I just sent a client over to Craig this week, and they're good friends of ours. And it's like, go talk to our buddy. And so you're missing out if you don't do this, everybody. And like he said, call 517-483-4893 because that's the number you want to get with Craig. All right, let's get back to this financial craziness stuff. So I think we've heard the word tariffs so many times now. It's like the key word of the decade. Okay. Personally, it appears to me that the tariffs are more of, again, we were talking about marketing with the alternative energy stuff in the beginning of the show. Mm-hmm. Marketing is everything. Okay. So in your opinion, Craig, is the administration and President Trump, what's your vibe on the tariffs and the marketing aspect of it? Do you agree with what I'm saying? Is there a partial agreement? What do you think?
When you're talking about from a marketing perspective, a lot of it comes to the area of trying to understand the impact of tariffs and the negative impact that it's had on the United States. And what I mean by the negative impact has been, we're talking about the United States applying tariffs. Nobody is talking about tariffs being applied to the United States. Now, they'll touch on, well, why is it that there are some countries out there that are not having tariffs against the United States? And they will focus on those countries, but they will not focus on the countries that have been applying a tariff to the United States products or limiting, if not completely blocking out certain industries from even selling to their countries, where we take a look, what product are we not allowing into our country that we purchase and buy and sell? The other dynamic has been the impact of globalization as a whole, because the other arguments that I hear, well, globalization's been good for every country. It's raised the lifestyle of every country. But they have to remember, every country is not a democratically elected republic. Republic is kind of the key word as it relates to the nature of the rules of subsidiarity, local decision-making, all of that. So if not all of the major playing fields are the same when it comes to tariffs, you have government entities applying taxes on products from the United States going there. Well, those taxes that are being applied from other countries are not going to benefit the people. It's going to benefit the country or the government. And so when we sit there and think it's raising the lifestyle of everybody, it's not the case. We know that. So how is it that our country has accumulated $36 to $37 trillion in debt? Has other countries accumulated that level of debt as well? Does that mean that we have raised that level of debt because we've kind of funded the growth of every country in the world? I'm speculating when it comes to that digression, but when I sit there and think of how the free trade agreement worked, okay, we're providing a North Atlantic free trade, but what industries were actually involved? Has it truly been free trade with Canada, truly free trade with Mexico, or was it just an arrangement where we can manufacture property or manufacture products less expensive in the other countries and then sell them back to our own citizenry? And that's where, how do we go about disrupting what has been in play for the last 30 to 40 years? And I think that's what happened on Liberation Day, April 2nd, when we had a huge policy shift of tariffs across the board on every product coming into the United States. That was one level of uncertainty taking place in the markets. The size of reciprocal tariffs, that was starting to open the eyes as to how much products, how many of our products were actually being huge tariffed in other countries, number two. Number three, there are countries that we did not have, that we're not charging tariffs, but we are to those other countries, and that was the application of a deficit difference between that country and ours. Those three primary pieces of uncertainty, if you will, or areas of tariffs created an uncertainty of what was going to be happening within the markets. Therefore, you had a lot of entities getting out of the markets in general, which you had a huge downturn. Once all of that stuff started shuffling through, then the market started correcting and coming back up again. So,
all right, hold that, because I got something I want to read here real quick, okay? Because this is exactly digressing into what Craig was just saying. I'm reading this from Edward Jones, okay?
Yep.
Nothing, just off the internet, okay?
Yep.
Okay, they're legit. Overall, stock markets have rebounded nicely over the last 2 weeks, with the Standard & Poor's up about 8% as the first quarter data has held up, and policymakers seem to be making progress on trade. Keep that in mind, everybody, because keep in mind that 2 or 3 pullbacks, as Craig said earlier, 2 or 3 pullbacks are normal in any year, especially as markets digest potentially higher inflation, softer growth. Nonetheless, we may see better sentiment heading into year end as the Federal Reserve likely lowers interest rates and earnings growth looks to recover heading into 2026. I look at that and read that, and I'm like, listen to Craig. He just told you guys all this, and then I've had this thing. What do you think about that, Craig? This reinforcing exactly what you were saying.
And you'll see that again, that's reinforcing the fact of it being a rather common occurrence of what level of corrections you can expect during a 12-month period of time. And then the reasons why you don't want to try to time the markets or get out, because you have some of the strongest rebounds that occur within the markets happen during the most volatile times in the markets. And if you miss those time periods, regardless of how many times you try to time the market right, it will impact your long-term performance on your portfolio. So that is where having a solid discipline within your portfolio and expectations of understanding in the markets will benefit you over the intermediate, if not long term. The short term, it does get scary. And sometimes if clients are living off of their portfolios, may have to pull back, say, you know what, we're looking at buying that car this month. We may push it off another month or two, where, we're looking at maybe going out to eat. And, maybe we won't go out to eat this time period, because if I do that, I'm going to have to draw off my portfolio, whatever it might be. Or if we have clients already taking automatic withdrawals, we don't increase that withdrawal. We just continue on and maintain it. If the markets are down, we know that the markets are going to be rebounding at some point. So the impact of that withdrawal rate, I want to make sure, and that's why, we've had that conversation, right? We can anticipate anywhere from a 4 to 6% withdrawal rate, net of everything, regardless if we started today and the markets dropped 20% the next day.
Yep.
I still would be happy and comfortable with you taking the withdrawals at the 4 to 6% withdrawal rate.
Yep.
Why do I say that time period? Because that's historically what endowments and foundations do in order to maintain their portfolios into perpetuity. Some clients are taking more, some clients are taking less. The ones that take more, I have to be more aggressive in the portfolio because we need the greater returns. Understanding that if we're more aggressive in the strategy, they will have more volatility and could have a deeper downturn when the markets have a level of correction.
Just what Craig was just saying, because we did, and I share some of our personal stuff on the show. That's fine. I mean, I want people to know who we are. We did increase our withdrawal a tiny bit, 2%, because we have some other expenses that are coming and we wanted to do some different things. I want to say this, and it was so easy. That's the thing about having a manager, maintaining discipline and having a managed portfolio like Craig and Karen and everybody over there at Ameriprise and his staff. Let me tell you guys, over time, since we've been with Ameriprise, I've made withdrawals because we have invested into other things. We've moved money from this fund over to something else, one of our real estate deals, whatever. It was so easy. It was so simple. It's like, this is the key. It's like, all I got to do is pick up the phone or pick up an email or text message and say, hey, I need this. Boom, it's done. Okay? That's, to me, that's peace of mind. And that's what it comes down to financial fitness. Ameriprise, I'm telling you guys, you got to have it in your life. Financial fitness is a key. This is the Tom Matt Show.
For more information on the Tom Matt RFZ mentality, please visit our brand new website at www.tommattshow.com. Subscribe to our podcast via your favorite podcast platform. Visit our brand new YouTube channel. or consistently motivating messaging. This is the Tom Matt Show.
Welcome to the Tom Matt Show.
Welcome back, everybody. Thank you so much for being a fan of the show and paying attention to our work and doing. I'm so grateful. We will start our 15th season in a couple of months. I am just flabbergasted that this program it's become popular. Our YouTube's doing really well. I mean, we have guests and sponsors like a Craig Stiles and Ameriprise. I mean, that's validation for you. Brock Fletcher. I mean, all of this stuff. Craig, you want to give your website one more time, phone number, whatever? You want to do that 483 number for everybody?
Yeah, my office number is 517-483-4893. Again, it's 517-483-4893. If no one had anything to write down, you can just Google my name, Craig Stiles, Ameriprise, and you'll get my website. And so you can schedule a meeting that way. Yep.
Craig.Stiles at ampf.com. That's his email. All right. I got a question for you here. Because this deficit spending, where you mentioned in the previous segment about that 37 trillion or whatever.
Trillion. That's how we do deficit spending. Got us there, right?
Did I get it right? Okay, good. I mean, it's probably 38 now. I mean,
hopefully,
or next week it'll be 38. Anyway, and I'm not trying. I mean, it's kind of sad in a way, but deficit spending. Okay, this is trickled into higher ed.
Yeah.
Yesterday, as we're recording this episode, which will be a month. The Michigan State University, which you guys know I'm very, very, very close to. I spent a lot of time out there, and their big letter in the newspaper coming up. They're cutting. They're watching. They're cutting money. Because we've been doing this deficit spending. They're getting ahead of the game. They're being smart. But let me tell you, there are departments at the university that are running deficits. People are not happy, and when you run these deficits, like I think everybody gets conditioned. It's okay to be in debt. So they just do it. It's like, oh, that's okay. I'm going to carry that $100,000 balance on my credit card or whatever. So, Craig, I'd like to ask you about deficit spending because we have got this thing in our, I don't know if it was the credit cards or what the heck happened over history, and it doesn't matter, but how do we sort of rein this in? I mean, we can never eliminate it, but
the hard part is where the deficit spending is coming from. Like when we talk about the universities and everything along those lines, they've become very dependent upon government contributions.
Yeah. Okay.
Quite frankly, I mean, because at one point in time, the way that schools would make and earn their money is the value of their education or the value of their research. A person they would justify their cost for their education. So supply and demand,
right?
In a lot of areas, if you had free market for supply and demand, and you only have 30 seats that you can put kids into a particular class, those 30 seats are going to become more and more and more and more valuable. The more people want to take that particular class or go to that particular school, and so that can justify an increase in tuition and increase that can allow for expansion and growth within that area. To where if you're earning more money than what your expenses are going out, then you're not going to have to rely on outside resources to supplement that growth or that expansion. That is kind of what deficit spending, if you have anticipated growth, you can justify some of that by going out and getting a loan to grow and expand. But typically that's if you're have a positive growth. In other words, the money that you have coming in, that's growing organically, that is what would be taking place. But if you are relying on grants or money coming in that isn't being generated in-house, and then you're expanding departments that are relying on this, and sometimes that comes in as a guise of research. All right, if we're going to research this, but we don't have anybody that really wants to pay this, let's apply for a grant from the federal government. They'll get a grant. Okay, that's not expected to be forever. And those grants sometimes are only meant to be for a short period of time. But then, we'll just apply for a continued grant. Well, then what's going to be the result of what comes out of those grants?
That's right.
And that is where that is where the deficit spending can be, to where now you're an entity that has now dependent upon that income, and that you've built a whole facility to do this type of research. Well, where's the value of the research? Can you get outside investments to come back in that can benefit from that research a little bit later on? Different universities will apply that research differently, will apply their education a little bit differently. And so this obviously gets outside the finance realm a little bit. But that is what I think really drives a lot of the deficit spending, especially when you're coming at from a school's level or perspective. Driving it home from a personal level, yeah. If you have a $5,000 limit on your credit card, and you're only making $4,000 a month, and you're spending $4,500 on your credit card every month because you can, how are you going to spend or buy that extra 500 or pay back that extra $500 if you're only making $4,000 a year or a month, right? And if you're going through making that $4,000 a month and you spend it on your credit card, and if you spent it on going out to eat, buying certain things for your apartment or your house or whatever it is, and you forget, oh wait, I gotta make a payment for my apartment. So if you're only making $4,000 a month and your apartment's $1,200 and you have a $4,500 credit card bill, now you're a couple $1,000s in debt on a monthly basis. Having that discipline to pull back and live within one's means, so this way you can save enough so that way you can start investing what you're saving, allow your investments to grow. So now your investments can then be that additional income to meet your needs going forward. That is what we kind of miss out on, that building of wealth through disciplined spending.
That's what we got to think about. I wrote down, as Craig was speaking, everybody, Craig Stiles, our guest today, Financial Craziness, Financial Fitness episode. I wrote down living within your means, and then Craig said it. It's the way it works here. I mean, I swear, it's like we're on the same wavelength with all of this stuff. We're balancing budgets. We're getting indoctrinated. We're getting brainwashed into saying this is okay. One thing I do with students a lot, Craig, when I have my Tuesday meetings, is I'm always encouraging them about our supplemental retirement plan. The only reason that Sandy and I are in a position that we're in now to be able to do this and we hit our numbers just like we wanted to was our supplemental retirement plan at the university, where I was squirreling away extra money, save, so that we could give that pile and Sandy's pile over to Craig and let him handle it. And it's worked out great. We need to encourage our children to save money. Look at your supplemental. If some people don't even know you got a supplemental retirement plan at your work, ask your HR about it, because they're so simple to use and they can help you so much because you're putting money in pre-tax. So anyway, I just want to let you know, living within your means and getting kids to understand saving money, doing all of this stuff is really, really important. All right. Should age affect decisions on our investments after 50? And Craig does not know anything about this question, everybody. Should age, we're not talking, age will obviously affect your decisions in investments, but I'm talking specifically, let's say 40, 50, and 60-year-old, 70-year-old people. Should age affect decisions in our managed portfolio during financial craziness? Tough question. Threw you a curveball, didn't I? Got to think about this one.
Well, yes. I'm just sitting there thinking of a couple of different ways to answer that and think of one that is more direct. So when I sit down, and when a financial advisor should be talking about is what their expectations are during retirement. So in my circumstance, as you're aware, a majority of my clients are 80%, 90% in equities to begin with. There's only two things that are going on in the markets, whether you're buying bonds, whether you're buying anything, or the markets in general, is you're buying something and you're selling something. You can buy a bond and you can sell a bond for a loss. You can buy a stock and you sell a stock for a loss. When they buy a stock, when they buy a bond, when they sell a stock, when they sell a bond, creates a statistic. And believe it or not, there are some people who are better at it, have specific investment disciplines, and then we try to match those types of investment strategies with the tolerance level of our clients, and then educate them on what those pros and cons are of the decision we make, right? I mean, just to use your example, we did make an adjustment. When you needed to take a little extra, we made an adjustment with one of the strategies as a part of the portfolio.
Yep.
Maintain growth, but this strategy is more dynamic and changes more rapidly than the others that are stayed focused and in their lane, so to speak. One kind of changes lanes a little bit. And that has done well for you as it relates to the pullback in the market. It's a growth strategy, didn't pull back as much. They're capturing a little more on the upside.
So I made a good move.
That adjustment isn't based on your age. It's based on the desire and need to withdraw a little bit extra for whatever the next phase is.
Exactly.
Right? So it's always not focused on age. It's focused on what the client needs their portfolio to do, and then match that with who they are, what their personality is like, their ability to handle investment tolerance, whatever it might be. So
give me a 30-second takeaway, and I want to give you a comment on that. Go ahead. Give me a 30-second takeaway.
So from that perspective, it's not about age. It's about what that person needs to live off of, and then match their investment discipline with their lifestyle.
I was going to say exactly the same. Should age affect decisions? It depends. It depends. Tolerance level and the whole thing, everybody. Become educated. Listen to our financial fitness episodes with Craig. Put on the podcast. That 80-year-old I met at the gym today, I asked him about podcasts. He's like, I'm showing him how to listen to a podcast because it's so helpful. This is where you get it. If our show fits your business or group's mission, we want to be of service to you through our guests, like a Craig Stiles and Ameriprise Financial. Guy's awesome. Sponsorships are available. Hit me up. You got to have a good fit. It's got to be a good fit around here. Always remember, before you can share love with others, you must love yourself first. Thank you to Sandy, Craig, Brock. Have a great week, everybody. Have a great weekend. Go out and ignite your life. The Tom Matt Show is a production of Boomers Rock Media. We want to bring your story to life. And lastly, I want to say thank you to Mitch Anderson and Vanessa, our production staff. You guys are the bomb. Love you so much. We are out.
The Tom Matt Show is produced by Mitch Anderson of Black Circle Studios. Original music from the Source of Light and Power by the Arc of All.